Good afternoon, ladies and gentlemen. Thank you very much for joining us here this afternoon as we talk about building a robust financial sector for a competitive economy. We will, of course, get into the nitty-gritties of what it is going to take for us to be able to do that. But just to set the context of where we find ourselves today in 2023, I think the prognosis is looking good. Everybody that you speak to at this point in time, not just within government but outside of government, also does believe that India is poised to be in a sweet spot. There is a lot going for us at this point in time, whether it is on account of the diversification of supply chains, or it is the fact that we have ensured that there is macroeconomic stability here, whereas the West is facing headwinds on that front. We've also seen a cooling off as far as inflation is concerned, resulting in the Reserve Bank pausing at this point in time. The Governor, of course, making it clear that this is a pause and not a pivot, but the hope and the expectation is that perhaps we've peaked as far as interest rates are concerned. When do we actually see the cycle turn is the question, but the expectation is perhaps towards October or past that. So without further ado, we do have with us a great set of speakers who will outline for us what they believe the course of the economy looks like, and more importantly, what they believe the execution roadmap in terms of measures that we need to put in place, in addition to the steps that have already been taken to ensure that we remain competitive and that we do have a stable financial sector. Let me introduce our panelists here to you. I'll start by introducing the Chief Economic Advisor. Don't really need to introduce him, but Mr. Nageswaran, many thanks for joining us here today. Also with us, Puri, the Chairman of South and Southeast Asia at JPMorgan Chase. Mr. Puri, appreciate your time. Mr. S. Ramann, the Chairman of the Small Industries Development Bank of India, or SIDBI. Mr. Ramann, it's good to have you. And Kaku, Nakhate, the President and Country Head, India, Bank of America. I want to pick up on the point that you made about be careful in the good times and don't repeat the mistakes of the past, and hopefully you believe the indigestion that we saw has found its way out of the system, and that's very evident whether you look at balance sheets of corporations or you look at balance sheets of banks. The deleveraging has taken place, the cleanup has taken place. You talked about the risks of overheating, but are we perhaps faced with a different kind of risk today, where we are seeing, in your words, incipient signs of private capital picking up, but perhaps not to the extent that the government would hope for, which is why the government keeps sending out the message to the private sector, go out there and spend. Is it a risk-off, risk aversion, or at this point in time, because of the uncertainty that we are faced with globally and perhaps not enough demand visibility domestically, the private sector is still holding back?
Shireen, you're absolutely right that right now it is not the time to worry about overheating risks, and that comes much later. In fact, I would be very happy if it comes even later than it came in the previous cycles. And also, as for risk aversion and caution, to a large extent it is understandable given the kind of developments we have faced in the world and also in India. Barely had we finished repairing balance sheets, we had two years of pandemic and then the war, its impact on commodities, and then sustained interest rate increases globally elsewhere. So to some extent the caution is understandable because there is less visibility on demand going forward. But that said, we do see signs of the corporate sector beginning to invest. You have seen that in the data on new project announcements, and we have seen that in the data on based on bottom-up cash flow statements of companies, that in the last 3 years, based on data available for the first 6 months of the financial year, in 2021 it was around 2.1 lakh crores, investments made by about few thousands of private companies, and 21-22 it was 2.7 lakh crores, and 22-23 it was 3.3 lakh crores. So it's been rising, and once we get the full year data, we will get the picture. And we know that the internal resource generation of companies is absolutely at a very high level, and therefore they may not necessarily have to tap either the capital market or the banking sector because they do have enough profitability to fall back on first. So I think I'm constructive and optimistic about the private sector capital formation cycle in this country. We have been waiting for it. It's already unfolding, and it's perhaps just as well that it unfolds gradually rather than too furiously.
But how gradual do you expect for this to pan out? Because as you pointed out, we've been waiting for a while now.
As I said, the numbers show that it is happening. It is happening, and capacity utilization in some sectors like steel and cement have reached a point where greenfield investments have to happen. And I think it is not just something that we are waiting for. I'm saying that it is unfolding, but unfolding at a steady pace, which is good enough for us.
Before I get the other panelists in, let me ask you a question in terms of competitiveness, and I'll put this in the context of the fact that we've now seen the Reserve Bank pause. Globally, we don't know what is going to happen as far as the US debt ceiling is concerned, whether they will arrive at a decision before the 1st of June or not. And the commentary from the Fed overnight seems to suggest that there is a split on whether we are pausing there as far as interest rate hikes are concerned, or the Fed will continue to hike rates. Do you believe that we are in a long pause, or do you believe that it is now perhaps possible that we could see a change in the cycle by way of rate cuts coming in even earlier than October, which is the expectation at this point in time?
Talking about India or the US?
India. The US is still considering hiking.
No, I have always said in my last 16 months on this job that I don't comment on monetary policy in public. So I'm not going to change that stance.
Okay, you want to take a stab at what you think the Fed is likely to do?
No, I think they have given the indication that they would be on pause in June. And I also don't believe that in the US case, I think rate cuts are imminent. I don't think so. Unless, of course, there are further financial accidents like the ones we saw in the last 2 months in March and April, etc. Because if you look at the macro data, they are still holding up very well. So I think stable for longer might be more likely than looser policy, but that's my personal view. Yeah.
Well, we will find out soon enough. Leo Puri, let me address the issue with you in terms of where you believe we find ourselves poised at this point in time, given the fact that there are significant global uncertainties and macroeconomic headwinds. And more importantly, from a competitiveness point of view, in order of priority, what next is the expectation?
Thank you. And I mean, first, the good news, I mean, to pick up on Anand's points, actually, we do have a much healthier financial system than we had 5 or 7 years ago. I mean, the measure of success of a financial system is one that allocates capital efficiently at relatively low intermediation cost while bringing about financial deepening or inclusion. So it's not a very, in that sense, complex task. It's actually quite straightforward, and we should always keep our eyes focused on this. In terms of capital allocation, I think we really hit another some years ago. I don't think it could have possibly got any worse. And where we are today is that as a system, we are allocating capital more efficiently, which is why, as Anand said, you are seeing much healthier balance sheets. It's not just the cyclical effect of high provisioning and coming on a bounce of that. I actually do believe we are better at allocating capital today as a system than we were some years ago, whatever the reasons. Intermediation costs are also down, which is also evidenced in all the numbers that you see, which means we're a more efficient system. Some of this is due to government intervention around consolidation of private sector, public sector banks, streamlining. The private banks, of course, have pushed technology, as have the government banks. And so productivity levels are also much higher, which is very important because it lowers the cost of access for all of us, whether we're businesses or consumers. And that's a great sign of health. Financial deepening is indeed one of India's success stories. And I think it's been recognized all over the world that what we did with, JAM and so on was really something that has followed through. And it's truly been a success story. So to your question, given that all this is good news, what remains to be concerned about? I think the first is that we are still a very bank-dominated system, and capital markets more broadly, which is ultimately the true engine for growth for a developing economy such as ours, remain somewhat anemic relative to our aspirations. We don't have unhealthy capital markets, we just have subscale capital markets, in my view. And I think we have to keep revisiting this issue because we can't really expect ourselves to grow given our sensitivity to dependence on foreign flows. So we could do what Indonesia, Thailand and other countries did and just open up the taps to foreign flows. for various reasons, our mindset and our political establishment and the RBI and so on is, in my view, highly unlikely to do that. That would be an easy option. So we're not going to get to 30% of our government bonds being held by foreigners or any of those solutions, which would be an easy way to bring in capital. So you really are talking about the development of our own markets, bringing back some of the business which is done offshore, which is where Gift City and other things come on stream. And that's a central issue. The second area of concern is that at this point, we are still we are a well-regulated system, which is a good thing. I think, again, the time has come to debate whether we are possibly a little over-regulated in some dimensions of the development of the system. So, again, we have an opportunity to, I think, revisit that.
Kaku, let's address the issue on what you believe are the points of concern and what you believe needs to be done at this point in time. You know, the two of you were at Gift City, and the hope and the expectation is that perhaps we are at some sort of an inflection point with Gift City picking up, that we will start to see this market develop in a much more robust way. You know, your thoughts?
I kind of agree with Leo very clearly that capital markets have to grow in India. Gift City is a big starting because at least we now have our own international financial center. We now have banks there. We have asset management companies and, of course, GDCs, and the ecosystem is building. And rather than, you know, rerouting things from Singapore and Dubai, actually getting in capital through Gift City clearly makes sense. The SGX, IFSC, you know, Nifty index also will be a big starting, and commodities would also be. But the big point is that we do need to create an ecosystem to have more people, especially startups, getting a lot of funding, because the new digitization that we are seeing all around is actually fueled by new players.
So how hopeful are you of flows? We've seen a pickup, but do you believe that that's likely to be sustainable?
See, I think we saw a huge amount of flows in FY20 and calendar year 20, where we saw 23 billion. And then last year, we had 16 billion flow out. And in the beginning of this year, you actually saw a flow out, but the last 2 months look very promising. And actually, the last May, which is currently on, has already shown 3.9 billion. So we are looking slightly better than rest of the world, but the global trends do overlay. So we will look slightly better, but we cannot duck the global trends. So right now, even though US has a major issue on deficit and markets may close, people have revised equity targets to 4,300. So similarly, India is looking much better than many of the countries.
Yes, that certainly seems to be the case at this point in time. But, you know, Mr. Ramann, let's address this issue of unlocking domestic pools of capital, and especially in the context of the startup economy. Again, it's not a new ask. It's been on the table for years now. In fact, just about a couple of days ago, the government issued on Friday. It was a furious Friday with many clarifications coming in from all quarters, including one on the controversial angel tax. But on balance, has enough really been done to create this domestic ecosystem of capital? And, you know, to Kaku's point, whether these 89 unicorns stay 89 in number or not, I think a lot will also depend on how sustainable their own business models are. You cannot just survive from one funding round to the next. But, you know, in terms of this finally unlocking this domestic pool of capital to service the Indian startup ecosystem, are we any closer?
So let me just thank CII for inviting me here today. Let me take that question from the perspective of what we've seen in the last about 6 years that SIDBI has run the Fund of Funds program on behalf of the Government of India. So this is 10,000 crores, of which 9,000 crores plus has been committed to over 110 AIFs, and they in turn have invested in about 950 startups. The AIFs themselves have brought in nearly 4 times the amount of capital that SIDBI has put into them. And the ask of SIDBI was twice the amount, so we've seen 4 times coming in. The interesting part is that we do not have a domination of foreign capital. So, you know, I'm not talking about today. Today things have certainly turned adverse, but what we have seen in the last 6 years is a very strong resurgence of domestic capital, and probably we've managed this in a more orderly manner. We had 2016 the fund of funds of DPIIT. We had in 2019 or 20 we had the SRI fund coming in, which was another 10,000 crores for MSMEs. So, we are talking about reasonably large pools of capital that have come in from the government of India, but actually catalyzed that much more from within the economy. Again, I'm not dismissing the contribution of foreign capital, but we've seen a resurgence of, or let me say, the first-time birth of 40% of those 110 AIFs are first-time fund managers. So, there is a maturity that I think we've seen within the economy. We've seen probably a lot of Indians who were overseas have now started coming back and finding this to be a more attractive market. So all in all, we need to put our hands together for the JAM, for the UPI, for all the, sort of important infrastructure rails that are in place.